Today we're going to talk about a powerful yet underused tax saving strategy. So let's get into it. The topic of today is income splitting. Income splitting is one of the most underused forms of tax savings. So, what is income splitting? Essentially, it involves redistributing income within a family to reduce the overall tax burden. Specifically, what we're doing is shifting income from a higher to a lower income family member. Now, you could do this with your kids, you could also do it with your spouses. For this example, we're going to talk about spouses. And what's the benefit? The benefit is it gives you lower tax, it puts you in a lower tax bracket. You have available tax credits and effectively having you pay lower taxes. So, how does it work? Higher income spouses earn RSP contribution rooms. And of course, if you're making higher income, in many cases, what you'll find is the person who has a higher income gets the higher RSP contribution room, of course, because of their higher earnings. So, higher income earners may accumulate more money in their RSP, which leads to being a higher tax bracket when you withdraw that money. And when you withdraw that money, in many instances, if we talk about RSPs, it's going to be in retirement. And even if you convert that RSP into a RIF, what will happen is you'll have a lot more in your RIF, which means the minimum amount withdraw that you could withdraw each year is going to be significantly higher. So, how do we solve that? We do what's called a spousal RSP contribution. So, to avoid a higher tax bracket in retirement, the higher income spouse can make RSP contributions to that spousal RSP, and the contributing spouse contributions are still deductible, which gives you immediate tax relief. Now, this amount of money will stay in the spousal RSP if the spouse, this is the lower income spouse who now has this money in their account, takes the money out within the first 3 years, the person who contributed, which is a higher income spouse, will be taxed. However, if they wait 3 years, the future withdrawal will be taxed at the recipient spouse tax rate, which will typically be lower. So that's one thing to consider. So, what's the immediate benefit, you may say? Well, the immediate benefit is you get the tax deduction. And over time, what we'll do is we'll equalize the retirement income between spouses. So instead of having one spouse with a disproportionate amount of RSPs, you will start to have, at least it be somewhat more equal. So over time, the strategy can significantly reduce the family's overall tax liability now, but especially during retirement when income needs to be drawn from that RSPs, it allows for equalization of the retirement income between the spouses. Now, family can then take full advantage of being in a lower tax bracket and avoid steep taxes that would otherwise apply if the higher income earner had significant amount in RSPs or potentially in a RIF, right? So, overall outcome is the immediate benefit, and then we also have the benefit of long-term tax savings, making it effective. But here's the thing, it is often underutilized. Many people just contribute to their RSPs without any type of consideration for a situation where they could, strategically take benefit by getting a deduction now, but even in the long term, have their RSPs be somewhat lower and still the same amount, but lower. That way, when they pull money from their RSPs in retirement, they'll be in a lower income rate. And here's a benefit. Huge benefit. The benefit is short term, long term, but a lot of times when we contribute to these RSPs, we're thinking, okay, great, I'm contributed RSPs, I'm going to get this deduction, and I'm going to take it out long term, 20, 30 years from now. And when I do take it out in 20, 30 years from now, guess what's going to happen? I'm going to be a lower income rate. We take for granted that we automatically will be in a lower income rate. In some instances, we are. If you haven't been strategic about this, in many instances, you may not. And in fact, what may happen is you will be in a higher tax bracket or similar tax bracket to when you contributed if you are not conscious and if you're not strategic in making the plans in place, which is why I strongly, strongly recommend that you get a financial plan and have this be one of the strategy that you look at to see if it makes sense for you. Hopefully this was helpful, and I'll catch you next week.